Good day. My name is Henda Stein, and I'm going to do the broadcast for estate planning for the subject LFBP 5800. The aim of this broadcast is to highlight certain fundamental aspects of your studies with specific reference to the quiz. Some aspects will not be discussed in too much detail and will therefore be for self-study. I will constantly be referring to the slides and notes of Marius Botha that's already on Blackboard for you and that explains the calculations. I expect you to know the calculations and to use this broadcast just to supplement your information and your knowledge to help you with the quiz. The first area that we are going to look at is interstate succession. Now we all know that interstate succession comes into play where a person dies without having a valid will. What is important to remember is that only the following people can inherit in terms of interstate succession from the deceased. It will be the surviving spouse and or the descendants. Now, when you do a calculation and you have a surviving spouse and descendants, this is where you will use the child's share, and that currently stands on 250,000 Rand. To determine what value the spouse will inherit, you will determine how many children the person that died had. And with this calculation, you will include adopted children and illegitimate children. So when you have determined how many children there are, you will add 1. You will look at the value of the deceased estates and divide that by the amount of children plus 1. The value that you receive and or get there, must compare to the current child share of 250,000 Rand. And the surviving spouse is entitled to the larger of the two amounts. Then also other people that can inherit in terms of the estate will be the parents and or the descendants of the deceased. This is where the calculation becomes a little more tricky because you do not determine a child's share here. But what you will do is you will see who are all in line to inherit. Will it be parents, brothers or sisters, children of brothers or sisters? And then the estate will divide equally between them. And it is important to remember that here the terms pars turbs and representation will be applicable. For example, if a descendant of a parent are predeceased but survived by children, the children will receive the benefit that would have fallen onto their parent. A spouse of a descendant will not qualify. Now, the nearest blood relation can also inherit, or the state. Please make sure that you know, in terms of interstate succession, what the terms pars turbs and by representation mean and how to be able to apply that to a practical example. Take note that adopted and illegitimate children will also be seen as the legal children of the deceased. The adoption must, however, be a legal adoption. Also take note who can renounce their benefits to inherit in terms of interstate succession and who cannot. The people who cannot renounce their rights will be minor children and people who are mentally disabled. Also make sure that you know that partners that are living together cannot inherit from each other in terms of Interstate Succession Act. Make also sure that you know the legislation and case law applicable to interstate succession. The legislation applicable to testate succession will be the Wills Act 7 of 1953. Now I'm going to highlight some areas that I want you to focus on, but please do not focus on this exclusively. Firstly, what you need to know is the formalities to have a valid will, and this must be that the will must be signed by the testator. In some instances, a commissioner of oaths must certify, and then the last one will be that the will must be signed by competent witnesses. Another area that is important for you to know is Section 2.3 and Section 2A of the Wills Act, and that is how a court can declare a defective will valid. There's a lot of cases on this, and you guys need to study that for your exam and for the quiz. Now, what basically it comes down to is that they look at the intention of the testator, but it's important that you know the link and the how Section 2.3 and Section 2A should be read together and applied in certain circumstances to declare a defective will valid. Another area of focus will be who can and cannot be beneficiaries in terms of the will and how and in what manner a person can be disqualified from being a beneficiary in a will. Of specific importance is page 814 in the textbook, which has to do with the content of a will. Now, the wording of a will is very important and can have a big impact on the interpretation and execution of that will. Make sure that you understand and know how certain clauses should read to be correct and what effect there could be. Look at what is meant by the terms substitution, collation, and accrual, also used as crescendi. When will those terms be applicable? How should the clauses read? And then if you need to look at a testator's intention, what conjectures will you use to ascertain his intention? And this will be in section 2C of the Wills Act. Always important will be section 2B of the Wills Act, which deals with testate succession and divorce. Now, if any person dies within 3 months after his marriage was dissolved by divorce or annulment, and that person executed a will before the date of such disillusionment, that will shall be implemented in the same manner as it would have been implemented if his previous spouse had died before the date of the dissolution concerned, unless it appeared from the will that the testator intended to benefit his previous spouse, notwithstanding the disillusionment of his marriage. It is very important that they must be adhered to this 3-month rule. If not, the ex-spouse will still inherit in terms of the original will. Also, when it comes to testate succession, there's a number of cases that is prescribed, and you need to study the cases and know how to apply it to a set of facts. It is going to be a safe assumption on my part to say that by now you all know that there are 3 types of matrimonial property regimes. Your marriage in community of property, a marriage out of community of property with exclusion of the accrual system, and then a marriage out of community of property with the inclusion of the accrual system. I am going to highlight some important points applicable to these different matrimonial property systems, but very, very briefly. Firstly will be marriages in community of property. If no antenuptial contract is entered into, a marriage will automatically be in community of property. The spouses' estates are joined together and each of them has a 50% claim thereon. An undivided half share of all the assets, but only from the date of marriage, should be applied. Before spouses got married, they still had their separate estates, and any action that was taken before date of marriage will still be legal and valid. Now, assets excluded from your matrimonial property regime will be donations and inheritance received from third parties on condition that they are excluded from community of property. They are not automatically excluded, and it must be stated in a will or a contract. Assets excluded in terms of other contracts, engagement gifts, assets subject to a fideicommission or a usufruct, and assets which will replace separate assets as was mentioned above. Please make sure that you study the slides of Marius Botha pertaining to the accrual calculation. I'm just going to highlight some important aspects. Firstly, the commencement value of neither party can be less than 0. Then, also another important fact that students tend to get wrong a lot of times is how life insurance policies should be dealt with in terms of an accrual calculation. Firstly, at death, and then at divorce. Make sure that you read all the necessary articles that has been prescribed and look at how it's stated in the textbook. There are also specific instances besides death and divorce where the accrual claim can be calculated. Make sure that you know where they are and when this can happen. Then, accrual claim is a contract between the 2 spouses. They are entitled to change the rules of the contract to amend certain clauses as long as what they decide will be valid in terms of the law. There are also certain assets that are excluded in terms of your accrual calculation. Now, firstly, any inheritance or donations will be excluded. Now, this exclusion happens automatically. You do not have to state in your will or in a contract that this inheritance or donation is specifically excluded. It just happens. Then also assets that the parties decide to exclude in terms of the antenuptial contract, non-patrimonial damages, donations between 2 spouses, for example, your engagement ring, and then Again, make sure that the slides of Marius Botha that has been put on Blackboard for you guys to calculate the accrual calculation is something that you know very, very well, and that you can do this calculation because it's very important for you as an estate planner. When it comes to estate planning, there's a lot of important calculations that you need to be able to do. Here is a whole list of them. Now, I'm not going to go through every single calculation in detail, as like I've said, Marius Botha has done some slides for you, and a lot of the calculations have been discussed thoroughly on Blackboard. Some of them I will pay a little bit more attention to, but the rest I will just highlight certain areas that are important and that students tend to battle with. So I will highlight these and make sure then that you know how to use it and how to apply it to a case study, and then how to then do a calculation so that you achieve full marks. So for the calculation of capital gains tax, what is important for you as a student to know? Well, first and foremost, you should know the new rates and exclusions applicable to individuals, special trusts, companies, and other trusts for the 2016-2017 year of assessment. Another important thing is for you to be able to do a capital gains tax calculation for people married in community of property as well as out of community of property. Then you must remember that at death there is a 300,000 yearly exclusion for each individual. Know all the exclusions. That will be your primary residence, your small business exclusion, and then also how to apply your rollover relief. That is when an asset is bequeathed to the surviving spouse. Capital gains tax will not be payable at the death of the first dying, but it will roll over and then only be calculated at the death of the surviving spouse. Now, when you do an in-community of property example, make sure that you do the calculation correctly and that each spouse gets the relevant exclusions applicable to them. Then also what you must remember is that personal use assets do not attract capital gains tax. What you can do is you can make yourself a little list, and when you hand in your paper, put on there which assets you did not include in your calculation and then state why. For example, a car, state then that it will not attract capital gains tax because it's a personal use asset. Now, what you guys need to determine when doing a capital gains tax calculation will be what the base cost for a specific asset is. Now, there are three methods to determine this, and as a student, you should do all three methods to determine which one gives the smallest capital gain to your client. Now, these methods will be firstly the 20% rule, then the actual market value on the 1st of October 2001, and then the time apportionment base cost. Now you need to know what the time apportionment base cost calculations look like and how to do them, and they are on page 709 on your South African Financial Planning Handbook. What you must look at and pay attention to here will be expenditures that was made before and on or after the 1st of October 2001, because there are different formulas applicable. You must know and understand these formulas, and you must be able to apply them to a set of facts. One important tip I can give you here is that if you are talking about part of a year, you should see it as a whole year when you do your calculation. In the textbooks, there's a lot of calculations to determine your time apportionment base cost. Make sure that you can do them. Look at the calculations on Blackboard that Marius Botha put on, because this is definitely something that you will be tested on. Limited rights is an often neglected area of estate planning, and people kind of avoid doing the calculations as they could be a little bit tricky. But unfortunately, in practice, you will deal with a lot of situations where limited rights are still being used. So it is very important that students get the hang of this. Now, what is important firstly is that you should know your definitions and what a limited right would be. This will be usufructs, fideicomissions, usufructuary interests. Students must be able to apply it and to, when they get a case study, determine what type of limited interest is referred to. Something else then to make note of will be that the tables at the back of the textbook, which will say what is the life expectancy of either males or females, and then determine a factor to that. And what you must always remember there is that we work with age next birthday. So if a person is 25 currently, you will use 26 in your calculation. Please make sure that when you do the calculation that you use the right tables, as it would be really silly to use the incorrect tables but then have the whole calculation further correct. So what we're going to do next is look at some limited interest calculations so that we can run through how to do the actual calculation. Okay, the first calculation that we are going to do is the valuation of a usufruct passing to another. Mark enjoyed a usufruct of a property with a market value of 700,000. On Mark's death, the usufruct passed to Minnie, a female, age 39 next birthday. After Minnie's death, the usufruct that she enjoyed will cease, and the bare dominium holder, Trevor, will become the full owner of the property. Calculate on Mark's death what the value of the usufruct that is to be included in his estate for estate purposes should be. Now, how do we do the calculation? Firstly, we determine the annual value of the market value. So you say 700 times 12% or 0.12 will give you 84,000 Rand. So then the present value of 1 Rand per annum, you look at Minnie's life expectancy, and if you look at your life expectancy tables, age next birthday, it would be 8.19866. So you say the value of the usufruct, 84,000 Rand, times the life expectancy factor, 8.19866, gives you a value of 688,687. Oh, I got that right. Now, for Mark's estate, the amount that will be included, therefore, will be the market value of the property minus the value of the usufruct that Minnie will receive, and that will be 11,313 Rand. So you see, you always have to separate the two. You have to do the calculation of the usufruct, and then what is left over will be the bare dominium. So firstly, make sure that you know what those definitions mean. That will make your calculations also a little bit easier if you know what we are referring to. The next calculation that we will do is where a usufruct or the other like interest ceases. So our example will be here, John Sr. died in 1996. He bequeathed his townhouse with a market value of 100,000 Rand to his son, John Jr., subject to his wife, Tracy, enjoying the usufruct over the property for the rest of her life. When John Sr. died, Tracy was 54 years old, so therefore you will use 55 age next birthday. Now, Tracy died in 2016, and John Jr. was 29 years old at that age, so for our calculation purposes, we will use 30 age next birthday. The market value of the townhouse was 400,000 Rand on Tracy's death. Now, how do you do your calculation? So, first of all, what we will do is we will calculate the ceasing usufruct in 2016. So we do the annual value where we say the market value at 2016 is 400,000 Rand times 12% or 0.12, and that gives you 48,000 Rand. Now, the present value of 1 Rand per annum calculated over John's life expectancy in this case will be 8.22694. So you will say 48,000 Rand times 8.22694, and that gives you a value of 394,893. Now, the value of the usufruct that was bequeathed to Tracy is calculated by the executor then as follows. You then look at what the market value was at John's death, and that was 100,000 Rand. And if you calculate the annual value over that, you will say 100,000 Rand times 12% will give you 12,000 Rand. And if you take that 12,000 Rand and you annualize it times 1 Rand per annum over Tracy's life expectancy, which you will then use, we use age 55 next birthday on the tables, which will make you look at the female tables, and it will be 7.69355. So the usufruct we will then have is 92,323 Rand. So the original bare dominium value will be your 100,000 Rand, which was the market value when he bequeathed it, minus the usufruct that was actually initially in his estate, the section 4Q deduction was 92,000 Rand. So what he received originally was the bare minimum of 7,677 Rand. That was what John inherited John Jr. inherited in terms of John Sr.'s estate. But if you now want to look at the value of the limited right to be included in Tracy's estate when she dies, you will say what is the current market value, which is 400,000, minus what the bare minimum was at the date of John's death, and that is 7,677 Rand. So the value that we will include in Tracy's estate will be 392,323 Rand. So that is how you calculate a limited interest that ceases, because it stops. So you calculate it over the term of the person in whose estate it will be, but you also use the values of the market value at the date of the death of the first person who initially bequeathed it, and then you apply that. The next calculation that we are going to do is a little bit trickier. This is not where we are going to calculate the value of the limited interest in a person's estate, but actually the value of the capital gains tax payable on the limited interest in a person's estate at his death. So the example that we're going to do is, I'm going to read it for you. Stephen, age 65, and his spouse, Mignon, age 50, bought a block of flats together in 2003 for 2.3 million Rand. And they made improvements to the property to the value of 100,000 Rand just after buying it. So obviously here we have our base cost and then 100,000 Rand that we must add to the base cost. Now, Stephen and Mignon has a combined will in which they mass their separate estates together. The block of flats is then bequeathed to their daughter Millie, who is currently 21, subject to a lifelong usufruct in favour of Mignon. At Stephen's death, the market value of the block of flats was 4.5 million Rand. Now you have to calculate the capital gain before the annual exclusion on the block of flats at Stephen's death. So let's see how we are going to do that calculation. Okay, so now let's look at how we are going to do this calculation. Firstly, if you want to do a capital gains tax calculation, you have to determine what the market value is, and that we give to you at 4.5 million Rand, and then what the base cost was when you bought the asset. And this one was 2.3 million Rand, and then improvements was made to the value of 100,000 Rand. So our base cost is 2.4 million originally. Also, what we need to calculate will be then the usufruct that will go to the spouse. And if you think about that, it will also qualify for your rollover relief. So the bare minimum that goes to Millie will be a capital gain in Stephen's estate. So let's do our calculation. So firstly, to determine the usufruct, it will be 4.5 million times 12%, times 7.88967, which is Mignon's life expectancy factor. That gives you a value of 4.260421.80 million Rand. And if you think about it, this will also be the Section 4Q deduction. And if you then therefore do your calculation, you will see that if you say 4.5 million minus the usufruct, you have a bare minimum value of 239,578 Rand and 20 cents. Let's look now at what the capital gain on the property will be. And this you will do by looking at your time apportionment base cost method and doing it as follows, where you say your bare minimum over your market value times your base cost. Now you've just calculated your bare minimum, you have your market value, and you also have your base cost. And if you do that calculation, it will give you an answer of 127,000 Rand 774 and 93 cents. So let's look. Okay, so what we have done now firstly is we have calculated the bare minimum here, and then we've also calculated the bare minimum of the base cost there. So what must we then do? We look at our capital gain and we look at what the proceeds are. So that is the bare minimum, which we've calculated up here. And we deduct the bare minimum of the base cost that we've calculated there. And that gives you the following answer of 111,803 Rand and 27 cents. Now, as the couple bought this together, they each own 50%, so you have to divide this capital gain that you have received by 2, and that gives you an answer, which will be the correct answer in this situation, of 55,901 Rand and 64 cents. So if you look at what the capital gain in Stephen's estate is, only 50% belongs to him, and we have our answer of 509 Rand and 64 cents. I am not going to do a complete estate duty calculation for you guys, but what you need to know is that you must be able to do it for either whether a person is married in community or property or out of community or property. I am going to highlight some new changes that has been made or some relevant points that is always something that students get confused with, so that you know that when you do a estate duty calculation or have a question to deal with, that you know how to apply the rules correctly. Now, look at the slides of Marius Botha that will explain to you how to do your estate duty calculations, and please make sure that you can do this. Do a lot of examples before your test and your exams. The reason for this is if you sit in an exam and now have to figure out how to do an estate duty calculation, you're going to waste way too much time and not do very well. So the first thing that we need to look at is that there was a legislative change that was made, and that is Section 3(2)(b) big A that was introduced to the Estate Duty Act. And this section will provide for a new inclusion in gross estate value when determining the dutiable estate. This change comes into effect when a person dies after the 1st of January 2016 and made any contributions to a retirement fund on or after the 1st of March 2015 that, and you have to look at the requirements, did not qualify as a tax deduction, was not applied as an exemption, or was not deducted from taxable lump sum in terms of paragraph 2 of the second schedule of the Income Tax Act. If this did not apply, that value will be included in the gross estate. And the aim of this was to close a loophole where a lot of people used lump sums to avoid paying estate duty. And this loophole has now effectively been closed for any lump sum payments made after the 1st of March 2015. So as this is a new legislative change, I would say wink wink, make sure that you know how to work this and how to apply it. One area that students constantly battle with is how to deal with insurance, life insurance policies when you do an estate duty calculation. Now this is on page 761 of your South African Financial Planning Handbook. Students must know when a life insurance policy should be included, how the deemed property rules work, and when the policy should be excluded. Now, the policies that will be excluded will be policies terminated under a duly registered antenuptial or postnuptial contract, policies affected under a buy and sell agreement, policies payable to someone other than the deceased estate, their relatives, or to a family company. This will include your key man policies. Also, what students get confused with is how to deal with your different types of insurance policies when calculating executors' fees. Now, there are a lot of articles on this. There's also a complete explanation in your textbook on how to deal with it, what the valuation would be, which amounts you should use in your estate duty calculation. And it is very important that students study this and know how to apply it to a estate duty calculation, because it is something that is asked every year in the quizzes, in the exams, and students constantly battle with it. With the policies that are excluded, make sure that you know in terms of legislation when they will be excluded, what needs to be applicable, and then be able to apply that to a set of facts, because it is giving away marks if you exclude a policy that should be included only because you did not study your theory and got some of the small aspects wrong. Because yes, that can be a little bit tricky, but also there's on SARS website a document that completely explains how to deal with business insurance and estate duty. So I think if you need any additional help trying to understand this, go and look at that document and that will clear it up for you. Something that is becoming more and more applicable as we as South Africans become more globalized is how to deal with foreign property in a person's estate. This is also tested regularly, and it is very clear if you look at the statistics that students still battle to interpret this. Now, foreign property is included as property in your estate, but there are certain instances. So if the deceased is ordinarily resident in South Africa, and now you must also be able to determine when somebody is ordinarily resident and when not, so you must look at those rules. So if somebody is ordinarily resident, all property situated all over the world is property for estate duty purposes. If a deceased is not ordinarily resident in South Africa, then only property situated in South Africa is included as property. If you look at Section 4E, the deductions for property outside Africa and acquired by the deceased can be the following. If he acquired that property before becoming ordinarily resident, or if he got the property after becoming ordinarily resident and acquired it by way of a donation from a non-ordinary resident South African person, or by way of inheritance from a non-ordinary South African person. So make sure that you know these rules and how to apply them. So if we give you a case study where we discuss foreign property, that you will be able to ascertain if that property should be included in the estate or excluded in the estate for estate duty purposes. And the only way to do that is to study these rules and then know it, so that when you have a set of facts, you can apply your knowledge and determine whether to include or exclude the property. As you will have foreign property in South Africa, you will also then have to look at foreign debts and how to deal with that in a South African person's estate. So if you look at it and you say debts due by the deceased to persons ordinarily resident outside of South Africa is deductible, but only to the extent that the amount of the debt exceeds the value of the assets of the deceased outside South Africa, and not include for estate duty in South Africa. So if you have an example where you say there's a deceased person and he has inherited property of 2 million rand in Australia, he has an estate of 600,000 rand in South Africa. So only 600,000 is property in South Africa. But then he also had debt of 2.1 million rand in Australia. So if you look, the value that will be included in his South African estate will be the value of where the debts increased the assets. So it will be a value of 100,000 rand, meaning his debt in Australia is 2.1. The assets that he have is 2 million. So what can be deducted against his South African estate will be the difference between the two. So if you look, the amount of debt exceeds the value of the assets of the deceased outside of South Africa. So that is how you will apply that rule. When you do an estate duty calculation for the value of a farm, and this is one that I like to call an oldie but a goodie, the value of the farm, if there is bona fide farming operations happening on that property, is included for estate duty purposes of 70% of the market value. Students still forget that constantly, and I feel that is marks that they give away, and the only time that this is applicable is with an estate duty calculation. It is not applicable when you do capital gains tax or an accrual calculation. Only when you do an estate duty calculation and you have a farm where there's bona fide agricultural business being run on that farm, the value of the farm for estate duty purposes will be the market value less 30%. Now, when you do an executor's fees calculation on that, the executor is entitled to use the full value of the farm when he calculates his fee, but it is actually considered poor practice, so most executors do calculate the value of the farm for their fees at also 70%. So please make sure that you don't lose marks on something that has been in practice and been used for a very, very long time. This should be something that students should automatically know. Students must always be able to do an executive's fees calculation. I don't think there has ever been a quiz or an exam that has been passed where a student did not have to do this. I'm just going to highlight some important aspects with regards to executive's fees. Now, first of all, it is a maximum value of 3.5% of the gross estate. Now, the gross estate will be, if it's in community of property, the total value of the shared assets, or if you have estate massing, also the total value of the massed estate that you can use. So it's the gross estate, but you do not include or deduct the liabilities. And when I say it's a maximum of 3.5%, it means that you can negotiate as an executor to have less. So if somebody asks you to say the executive's fees and calculate it at 2.4%, you're entirely able to do that, and it is legal. You can just not charge more than 3.5%. Now, if the executor is a VAT vendor, it will be 3.5% plus 14%, which will give you 3.99%. And also, the executor is entitled to the highest fee on the actual value of the property handled by him. No executive's fees are charged on use of rights or limited rights. Also, policies that do not pay out to the estate, no executive's fees is charged on that. Please make sure when you study your different policies and your deemed property, when executive's fees will be charged on it and when not, because that is something students get wrong so many times. Also, when an executor is dealing with an estate, he can charge a fee of 6% on all income generated in the deceased estate after the death of the deceased. This income is, however, not included for estate duty purposes, so you will not reflect that in the L&D account, and therefore the expenses related to that income cannot be deducted from estate duty. So basically what that boils down to is the income generated after the deceased has passed away is not reflected in the estate account, and therefore that 6% that the executor can charge on that fee can also not be deducted from estate duty purposes. That is also something that you must focus on and deal with when you deal with the administration of a deceased estate, and this is something that people often forget and neglect to do. So make sure that you can do an executor's fees calculation. Also remember, when it's in community of property, there's a chance that you might have two executors' fees calculation. If there are assets that does not form part of the joint estate, you need to do an additional executors' fees calculation for that. So just take note. Another area where students sometimes make mistakes, which they shouldn't, is the Section 4Q deduction, amounts bequeathed to the surviving spouse. Now, whether you will have to calculate it because it's actual assets being bequeathed or whether it's the residue, this is a calculation that is vitally important in every estate duty calculation. Also remember, and this has happened before, that you cannot have a Section 4Q deduction if you do not have a spouse. So please, I don't always know how students get to these values, but make sure that you do not fall into that trap. Now, if you look at property that accrues to the surviving spouse, that will be deductible for estate duty purposes. And the property must have been included in the estate of the deceased. And then the deduction must be reduced by so much of any amount that the surviving spouse is required in terms of the will to dispose to any other person or to a trust. For example, in the example here, if you bequeath an asset to the surviving spouse, but there's a bequest price that you attach to that bequest that you make, for example, in this case will be 500,000 Rand. The Section 4Q deduction is not the market value of the property, but the market value minus the bequest price, because only 2 million Rand, as in this example, will be the benefit that the spouse will receive. So make sure if there's a bequest price linked to something that you deduct that from the market value before including the value for the Section 4Q deduction. Also be aware that no deductions is allowed in respect of property that accrues to a trust established by the deceased for the benefit of the surviving spouse if the trustee of such a trust has a discretion to allocate such property or any income therefrom to any person other than the surviving spouse. So if you have a discretionary trust and you have more than one beneficiary and you bequeath a property just to that trust, the chances that it will qualify for your Section 4Q deduction is very slim. You will only qualify for a Section 4Q deduction if there are no other beneficiaries on the trust except the surviving spouse, or if it is not a discretionary trust where the trustees do not have a right to say who the beneficiaries must be, but if it's a vesting trust with only the surviving spouse as the vesting beneficiary, then you will be able to qualify for your Section 4Q. But a bequest to a normal discretionary trust will unfortunately not qualify. Then what you must also think about is that it is not required that the amount actually be bequeathed to the spouse in terms of a will. If you have a life insurance policy with a beneficiary clause on, and that beneficiary clause states that the surviving spouse gets the benefit, the insurance company will pay that benefit directly to the surviving spouse, but still she gets or he gets the benefit, and will therefore you can use that amount and deduct it in terms of Section 4Q. So just remember, if you have a policy with a beneficiary clause on and the beneficiary is the surviving spouse, you can deduct the value of that policy in terms of Section 4Q for your estate duty calculation. The current rule is that every person qualifies for a Section 4A abatement, and that currently stands on 3.5 million rand. Now, the availability of this abatement, together with the Section 4Q deduction, enables estate duty to be deferred to the surviving spouse's death in the case of married couples. Now, in terms of the amendments of Estate Duty Act of 2009, the abatement may now be transferred to the surviving spouse in the event that the deceased spouse did not make use of that abatement, or if the deceased person only made use of part of the abatement, the balance may be transferred to the surviving spouse. So the second dying spouse may make use of this rebate determined as follows. You will then have 3.5 million rand that wasn't used, and then the 3.5 million rand in the surviving spouse's estate, which gives you effectively an abatement of 7 million rand. What you must also remember is that if there is more than one spouse, the abatement must be calculated by using the number of spouses and not the proportion in which they inherited. So basically, the rule then should be is keep on marrying, and you can try and defer estate duty as long as possible. Okay, that's obviously a joke, right? I've also put an example for you to help you to do a calculation where you defer the abatement and then how to apply the difference. The calculation of the residue is a very important calculation, especially if it says in terms of the will that the residue is bequeathed to the surviving spouse. Then you have to do this calculation, add it to your Section 4Q deduction before you can do your estate duty calculation. So let me explain to you what the residue in an estate is. In short, well actually in long, it will be the total assets, and from that you deduct all the deductions, the taxes, the costs, bequests to others or legacies, property that others has a right to, and insurance policies payable to other parties. So basically what is left over. Now, what you must also remember is that there are certain times where the residue is not always bequeathed to the spouse, and then you will calculate the residue after the estate duty is payable. Now, here I have for you a quick way to just do your residue calculation so that you can understand and never make a mistake with this again. Firstly, here you will say what your net estate is before your Section 4Q deduction. Then you deduct all insurance bequeathed to the surviving spouse. So all policies where there is a beneficiary clause on or that pays out directly to the surviving spouse. Then all legacies, meaning where it is expressly stated in the will that a certain asset is bequeathed to somebody. Then all policies payable to other parties. So if there's a beneficiary clause on or if it belongs to somebody else, any cessions. So if you deduct all of that from your net estate, and remember, your net estate is already the value of your total assets minus your administration costs, minus your liabilities and other deductions that you have, you will have your residue. And if in terms of your will, your residue goes to your surviving spouse, then you will put this value right here in your estate duty calculation for your Section 4Q. But then also remember, if you have a policy payable to the surviving spouse, that one must also then be added under your Section 4Q deduction. So the residue, just to recap, what you have left, your net estate before your Section 4Q deduction, minus insurance bequeathed to your spouse, minus legacies, minus policies payable to other parties. And that will give you your residue for estate duty purposes. When doing an estate duty calculation, students must always do an apportionment of that estate duty if or when it is applicable. The reason for doing that is that the reduced amount can be used in the liquidity calculation, and also if you do an estate duty addendum, that forms part of the estate duty addendum and is something that you should always do. Because if you think about it, the estate is liable for paying estate duty, but if individuals must pay certain portions of it, the liquidity situation in the estate could be drastically improved. Now, an executor is appointed to ultimately pay their estate duty, but in certain instances, there are people that benefit in terms of the estate that will be responsible for the payment of the estate duty that those assets will attract. So how it works will be beneficiaries of a usufructuary, fiduciary or similar annuities, certain policy proceeds if there is a beneficiary clause on them. So if you have those in your estate, the executor must pay the estate duty, but then he can claim back the estate duty of the beneficiaries as stated above. And to do the calculation is very, very simple. What you do is you say the net value of the specific property. So for example, let's say it's policy proceeds of a policy with the beneficiary nomination on. Then you have the net value of your estate. You divide that and then you multiply it with the total estate duty payable. That will give you the portion of estate duty specifically attributable to this specific asset. And remember, this is something that sometimes is not asked, but is assumed that if there are any policies with beneficiary clauses on, beneficiaries of usufructuaries, fiduciaries, or similar annuities, the student must know that they must do an apportionment of estate duty and that that amount should be then applied in the liquidity calculation. So please make sure that you do not lose unnecessary marks by not apportioning your estate duty. One of the most important calculations you will do as an estate planner is to determine the liquid state of the estate. And I'm not meaning how watery the estate is. It is to determine if the estate has got enough cash in it to pay all the liabilities and debts that arise from dying. Because, well, like we always say, it's expensive business, dying. Now, there may be a cash shortfall or a cash surplus in the estate. And if there is obviously a shortfall, you as an estate planner must make recommendations to overcome that shortfall, and how you do it will determine on a lot of factors. So let's determine or see which assets and values we can use when we have to determine the liquidity in an estate. Now, possible sources could be an accrual claim, policies payable to the estate. If there's loan accounts that must be repaid, it can be claimed back. Selling price of assets, if there's buy and sell agreements, also investments, bank accounts, and other cash that are in the estate. One of the tricky areas would be a share portfolio, because if you think about it, shares are obviously linked to your markets. And if you use this share portfolio in a liquidity calculation, and at the time of death, the markets are actually in a downward spiral, the value could not be as what you determined in terms of your liquidation account, and you will now have a lesser amount. So I always suggest that you do not put in shares in your liquidity calculation. Also, if you think about it, that the sale of shares is a capital gains tax event, and then will increase the capital gains tax payable. So what you can do in these circumstances is make an assumption and clearly state and say that you do not use your share portfolio in your liquidity calculation. You explain your reasons, and then you leave it out, and then usually people will work with that assumption. And also with your clients, if you explain it to them, they tend to understand and agree with your assumptions here. So what you must also then remember when you do your liquidity calculation is, if you can apportion estate duty, do the apportionment first, and then only put in the value that the estate is liable for estate duty in your liquidity calculation. So firstly, what you do is you put down all your liabilities. Also remember to add here any cash legacies, because you must make sure that you have enough cash in your estate to give effect to the wishes of the testator in his will. So you put in all cash legacies, all liabilities, all debt, all costs, administration expenses, estate duty, anything that needs to be paid in terms of the estate. And from that, you deduct all your actual cash that you have available. Also, you can explain to your clients, and in practice, if they state that assets should be made liquid on death, what the effect will be of selling these assets in a auction at death. That is not always the best practice, because you do not get the best prices for a lot of the assets. So just explain that to a client if you deal with something like that in practice one day. But for our calculations, if it is told to you that you must sell an asset, you will use that cash value in your liquidity calculation. So to determine what your liquidity calculation is, you will look at what your cash available is, and then what needs to be paid, and see if you have a shortfall or a surplus. Now, what you must also be able to calculate is the value of an insurance policy, if you want to determine that that insurance policy must either cover your liquidity shortfall or a debt on a specific asset. So what you must then determine is, will that insurance policy attract estate duty? Will that insurance policy attract executors' fees? And then adjust the value accordingly. Now, in your textbook, there is a formula that you will apply to the value of a policy if only executors' fees are applicable, or to the value of the policy if executors' fees and estate duty is applicable. Make sure that you know that calculation and will be able to apply it to certain circumstances. And if you can do that, you will not have problems with your liquidity calculation. Successive death rebates is also an aspect that we test a lot in your quizzes and also in the exams, and students still tend to battle with this. It is important for students to know that a successive death rebate allows for tax alleviation where a beneficiary dies shortly after receiving an inheritance. The reason for the rebate is that if a beneficiary receives an inheritance from the deceased who died less than 10 years ago, it would be unfair for the beneficiary to now pay 20% on the property, as she only possessed it for a very small portion of her life. Now you get successive death rebate tables, and these tables will be available in your textbook. Make sure that you know how to apply these tables, and also make sure to which assets you will have to apply it and which assets will be applicable for use in your successive rebate calculation. If you can do that, you will not have a problem with your successive death rebates. Ladies and gentlemen, that concludes our broadcast for estate planning. Thank you so much for taking the time to listen to this. What I want to reiterate again is that make sure that all the information, all the calculations that is put on Blackboard for you with regards to estate planning, you have, and that you know it. The calculations of Marius Botha is vitally important. Make sure that you can do all these calculations do a lot of examples, look at old exam papers and do examples to make sure that you understand what is being asked. It does not help that you get into your exam time and then try and figure out how to do a calculation. Also on the slide here, I mentioned important things that students get wrong a lot of the times, also things that students do not understand. Make sure that when you do your calculation, you look at this broadcast and you understand and interpret what I have said and where you should apply it. Good luck with your quiz and also for the exam, and hopefully that you all do very, very well. Thank you very much.